Hello and thank you for watching this video of the disadvantages of S corporations, brought to you by Tommy Brown, Enrolled Agent Tax Resolution Specialist. Due to the economic circumstances, S corporations are the fastest growing business entity in the United States, and they are great for tax reasons. But warning, they are also the least understood. You need to be aware of the potential pitfalls of owning an S corporation, and so in this video I'm going to talk about 3 failures of owners and shareholders, as well as 3 potential issues facing owners and shareholders. The first potential failure of being an S corporation shareholder or owner has to do with failure to elect status by the deadline of the 15th of the 3rd month. S Corp should be set up by an attorney with the state, and then election is submitted to the Internal Revenue Service. This mistake is realized in the following tax year when owners bring their tax information to their tax preparer. The second failure is failure to keep minutes. Officers must meet at minimum once a year, and minutes of all meetings held by the officers should be maintained. Make sure the minutes include bank account information, S corporation election, loans to and from shareholders, compensations, distributions, and any other material matter. The third potential failure is failure to separate personal assets. The main reason to incorporate is to protect you personally from any negative events that may take place against your business. In order to keep that personal protection, you must set up and maintain a corporate veil. Maintain separate bank accounts and keep them separate. Remember, the corporation is not to be used as a personal bank account. And on the other side of that coin, be sure that items aren't bought for the corporation from shareholder funds. Moving to the first potential issue, if you choose to make a loan from the corporation to a shareholder, the loan must be documented. Make sure to maintain due from and due to figures, and also the loans must bear interest, and you should establish a payment plan. The second potential issue has to do with compensation. Any salaries paid must be for services provided, and the salary must be adequate. S Corps must pay reasonable compensation to a shareholder employee in return for services that the employee provides to the corporation before any non-wage distributions may be made to the shareholder employee. The amount of reasonable compensation will never exceed the amount received by the shareholder either directly or indirectly. Distributions and other payments by an S corporation to a corporate officer must be treated as wages to the extent that the amounts are reasonable compensation for the service rendered to the corporation. And the final issue we'll talk about in this video is that of having an office in the home. This is a tax deduction available to shareholder employees, and it includes out-of-pocket expenses. But remember that this is to be taken on Form 2106 of the Schedule A and is not a Schedule E item. This deduction is limited to the 2% floor of the shareholder employee's AGI, and all 2106 rules apply.